The Income Tax Act 2025. Today is day 32 and I am studying section 35 and section 36 of the act. Starting with section 35, which deals with the amounts which we cannot claim as expenses or are not deductible in circumstances. First one is section 35A, which deals with the tax paid on income. It says that if we 100% there will be 100% disallowance in case we pay any income tax. The amount of income tax will not be allowed as expenditure. In case we provide any perquisites to the employees and we pay the taxes on such perquisites on behalf of the employee, then that payment of tax of on perquisites to the employee will not be allowed as expense for the business or employer, and such perquisites will be exempt in the hands of the employee. And then there is tax paid in foreign country. If we make payment of tax on foreign country, it will not be allowed as expense. There will be 100% disallowance in all three cases. Then comes section 35B. The first clause of this section deals with the case where we make payment to a resident person, but we did not deduct any TDS on such payment, or we deducted TDS but we did not deposit it to the government before the due date of return of income under section 263(1), which is like 31st October in case of companies. Then in such cases, if we fall in either of those conditions, there will be 30% of expenditure disallowance in the current year. Means in the current year we can only claim deduction for 70% of the expense, and then we can claim deduction of the rest 30% of in the year we deposit the same TDS. Here are a few examples of the same. BB Virtuals made payment of 7 lakh to AK sir. If they did not deduct TDS, there will be 30% disallowance in the tax year 26-27, and the rest will be allowed in the year they deduct TDS. And in case they deduct TDS but did not deposit it within the due date of return of income, that is 31st of October 2027. These are three cases where they have done so, so they will be allowed 100% of the expenditure in tax year 26-27 only. But in case they deposit the same after the due date of return of income, for example 15th of December 2027, then in tax year 26-27 they will be only allowed 70% of the expenditure, which comes to 4,90,000. And since they deposited the same in the next tax year, the rest of the 30, which means the 30% of the expenditure will be allowed in the next tax year, which is 27-28 in this example. Similarly, in case they don't deposit it in next tax year also, and they deposit it in the tax year after the next tax year, which is 17/4/2028, then that 30% will be allowed in tax year 28-29. Then there is the second clause of section 35B, which deals with the case where we make payment to any non-resident or any foreign company and we do not deduct TDS on it, or we do not deposit the TDS within the due date of return of income under section 263(1) of the act. Then in such cases, in case of non-resident, there will be 100% disallowance of expenditure. Means we cannot claim anything of that expenditure in the current year, but when we comply with these requirements, then we'll be able to claim such expenditure. Like in this example, Dandia Private Limited hired Shakira for some performance on 31st December 2026 and made a payment of 20 lakh. They deducted the TDS on the date of payment, but they deposited the same. If they deposit the same within the due date of return of income, then it will be allowed in tax year 26-27. If they deposit the same after the due date of ITR, then it will be allowed in the tax year in which they deposit the same. Like in this example, it's tax year 27-28. Now, in case in the above example, they did not deduct the TDS at all, and they deducted it in the next tax year, for example, 16th of April 2027. Then this expenditure will be allowed as deduction only in the tax year of 27-28 and not 26-27, even if they deposit within the date of ITR, because deduction is more important. Another example is, this is another case where in case we did not deduct TDS, but the person we made payment to has declared the income and paid taxes on return of income, then it will be allowed as expenditure. Like in this example, PB Virtuals did not deduct made payment of 7 lakh rupees to AK sir, but they did not deduct any TDS on the same. So there will be 30% of disallowance in the tax year 26-27 because of non-deduction of TDS. But AK sir declared the income of whole 7 lakh rupees and paid the tax in the return of income. Then a CA will certify this fact in Form 149, and when he does so, it will be assumed for the purpose of income tax that BB Virtuals has complied with the requirement of TDS. Means it he will be allowed the rest of the 30% of deduction, but it will be allowed in the tax year in which the return of income has been filed and taxes has been paid. Means the tax year in which the person to whom payment was made complies with the requirements of declaration of income and payment of tax in the return of income. In that year it will be allowed as deduction, the rest 30% of it. So in this example, the AK sir made the payment of tax on 19th of August 2027. So it will be allowed the 30% which was disallowed due to non-deduction. It will be allowed in the tax year 27-28, and there will be also interest charged on the same because of late payment. Then comes the third clause of the same section 35B, which deals with the cases of the employee welfare like provident fund or other funds. It says in case the employer deposits some amount in provident fund, at that time no tax is deducted, but he has to ensure that when the payment is received by the employee from such fund like from provident fund, that it has to be made sure that the employer calculates TDS on such salary, which includes the payment of PF and deducts the TDS on the same. This is a provision which looks into the future and says that when an employee receives payment from any employee welfare scheme, we have to make sure that we deduct TDS on such payment received by the employee. Then comes section 35C, which deals with the salary payable outside India or to a non-resident. In such case, there will be 100% disallowance. There will be 100% disallowance in case TDS is not deducted, or in case TDS is deducted but not deposit up to the date of TDS payment. it, Here it's not up to the date of return of income, but it's up to the date of TDS payment, which is the 7th of next month usually. Then in such case the deduction will not be allowed. Then is the last case of section 35B, which deals with the case where royalty is charged by the state government from this state government undertaking. And if this royalty is collected exclusively by the state government, then such expenditure is disallowed for the state government undertaking. Like in this example, Delhi government charges Delhi Transport Corporation a royalty of rupees 5,000 crores. Then in the profit and loss account of the Delhi Transport Corporation, they would normally like to show the royalty as expense and claim deduction, but it is disallowed by the government. Why? Because when when DTC earns income, it pays income tax which goes to the central government. The state governments wanted to keep the money for themselves, so they would charge royalty or other expenses to the state government undertaking so that they do not have any tax liability, and the entire income goes to the state government only, so they can use it for their own state only. So in order to prevent this, it was a rule introduced to disallow such payment of royalty by state government undertaking to the state government. These are all the subsections of section 35. There are section 35E and 35F which I have not discussed, which will be discussed in chapter number 6. Then comes section 36, which deals with those expenses or those payments which are not deductible in certain circumstances. First one is section 36(2), which deals with the payments made to the relative. When we make payment to a relative, it will be decided by the assessing officer. In case the payment is unreasonable, he will disallow such expense. In case it is reasonable, he will allow such expense. And what comes in the definition of relative is given in section 36 subsection 3, which is here. So, in case of individual, his spouse, mother, father, brother, sister, lineal ascendant, and lineal descendant are his relatives. For HUF, AOP, BOI, his members and relatives. Firm, LLP, partners and their relatives, and for company, directors and their relatives. And in case of any person, which is any SSE, in case he has a substantial interest in any person or his relative, they will be considered as related. And in case any person has any substantial interest in SSE or his relatives, then they will also be considered as related. Now, what constitutes substantial interest? In case of company, it means 20% or more of shareholding. In case of firm AOP BOI, it means 20% or more of profit sharing ratio. Now, in case there is a holding company and it has multiple subsidiaries, those subsidiaries are considered as related between each other. Then comes section 36(4), which deals with the disallowance in case we make cash payment of more than 10,000 rupees in a single day to a single person. It says that if we make such payment in the modes other than the specified banking and online modes, it will be disallowed. There will be 100% disallowance. Means in case we make payment through cash or cross check, which is not considered as a specified banking mode, it will be disallowed, 100% disallowance. But the limit is 35,000 rupees in case of transporter. These are some examples. This is a case where in case we claim the expenditure on accrual basis in one tax year, and then we have to make a payment in some other tax year, and in that tax year we do not comply with the requirement of specified bank mode. So like in this example, in tax year 24-25, BBVPL made purchases of 5 lakh rupees and claimed expenditure of 5 lakh rupees, the entire amount. Then they had to make payment for the same purchase. So in tax year 26-27, they made payment, but they made the payment in cash mode. So this has to be disallowed, but we cannot go back to tax year 24-25 to disallow it. So it will be included as income under the head PGBP for tax year 26-27 under section 36(5). Now there are further few cases here. Expenditure. This section which deals with the payment in cash, it does not apply to any commission agent, because a commission agent is not like a normal trader. He does not have income from sales and purchases which he claims as expenses. He simply has only commission income. So in case he makes or receives payments in cash, it is allowed. But in case a commission agent is like a purchasing goods and then selling them, it will be considered as trading activity. Then this section applies. Then he has to comply with the requirement of 10,000 payment in banking modes. Now this is a case, in case this is an example, if you have some agreement with the party that you will make payment in cash only, but then in order to comply with section 36(4), you make the payment in banking mode so that you don't get any disallowance. It says that he has no right to sue you for that, because you are just complying with the requirement of the act. Then there are certain exceptions to this section 36(4). This includes the payments made to any institution like RBI, banks, cooperative bank, or LIC. This also includes government payments, which means there are some conditions where the government mandates us to make payment in cash. Then in that case, it will be allowed as expenditure. Then comes the case of book entry, which means if we have a receivable and payable for the same person, we can set it off easily. We don't have to make payment or otherwise or comply with any such requirements. Then comes the case of where we make payment to the producer of any agri product, dairy product, fish product, poultry product, horticulture produce, or any purchase of any animals in cash. Then it is allowed as deduction. But we have to make sure we make payment to the producer and not to any retail chain like Big Bazaar or something. Then comes the case of cottage industry, which works without the aid of power. In case we make the payment to producer, then it is allowed as deduction. Also the case of unbanked area. There are certain areas where no banking facility is available, so we can make the payment in cash in that case. And there are a few more cases here. In case we have an employee who we have posted to some location other than his usual place for 15 days or more than 15 days, and that place has no bank account, so we have to make payment in cash in order to enable that employee to make expense, and we have to make payment in cash, then it will be allowed for deduction. It's also available as deduction in case he's on a ship and ship is at some other place, which means maybe outside India or some place where they have no local bank account. So we can make payment in cash, payment of salary in cash, no other payment. Then we have agent payments. The agent must pay cash for goods and services on payment on payer's behalf. And there is a case of foreign currency purchases or travelers check purchases by, but it should be through only authorized dealers or money changers. That is it.